Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is Michael Becker.
Hey, Paul.
Michael, we have Steve and Shari Gould in the podcast today. And they just closed on a 184-unit apartment building in Dallas, Irving, Texas. And many people go different ways to get to success, to owning apartment buildings. And I thought what we would do is kind of drill down about what they did and help create kind of a roadmap for some people who haven't been able to get into multifamily. They're a perfect example of what they did before that had nothing to do with multifamily and now what they're doing today. So we're going to spend a little bit of time in the podcast with Steve and Shari Gould. And Goulds, how are you?
Wonderful.
Good,
Thank you. Thanks for having us.
Good. So you guys are married and you came into the multifamily business from a completely different path of life before you did it. So Shari, tell me a little bit before you got into multifamily, what did you do?
My background is journalism and technical writing. I did that for probably 15 years or so. And Steve and I got married and had kids. And our first one was due to be born, and I got laid off from my tech writing job downtown 2 weeks before she was born, and I never went back. So I just freelance wrote technical articles for high-tech publications, kind of stuff that would put you to sleep if you had insomnia, unless you were an engineer. Anyway, so I did that for a few years while the kids were young. Steve got us involved in real estate as a stream of passive income. So the 5-year plan was to retire him by the time he was 45. And that was my goal.
Now, Steve, did you retire yourself or did you get retired?
I must admit, Shari retired me. She needs to take all the credit for, especially early on.
Not all
she
the
did all
credit,
that.
because he definitely worked some late nights helping out with the bookkeeping, accounting side of things. But we started off with single family first 3 years, and then, with a lot of mentorship and just learning from other people in the business that just the path to go and how to take this on, the multifamily side of things. I was far more comfortable with the numbers and just how to evaluate an asset at that point. And so that's when we actively started pursuing our first multifamily property.
Okay. And then Steve, let's get back to you again. What did you do before you got into multifamily?
I was a software developer in corporate America, 20 years experience doing some fairly large systems, worked for that former big video rental store, no longer in business.
Yeah. So just like what Shari was saying is that you got retired from that big blue box Blockbuster store and that you were looking for other opportunities. But before you actually left that job, you already got into real estate. So kind of give me a little bit of an idea about why real estate and not stocks and bonds, and why not multi-level marketing? Why were you drawn to the real estate piece?
Well, I'd already been investing quite heavily in stocks and bonds, both in retirement accounts and outside of retirement accounts. I'd done a lot of options trading and made some money on that, but it was not a viable kind of income in the sense that it wasn't something that could sustain the whole family.
Sure.
If I didn't have a job. So we're looking at ways to replace Shari's income when she got laid off and decided to stay at home. But then when we started looking into it more and got involved with this real estate mentor group, Lifestyles Unlimited, we then saw there were more opportunities to actually replace my income as well. So
Now, did you tell your friends and your family that you were going to go into real estate right at the beginning?
I think
Yeah.
I told my mom, because our first house was under contract at Thanksgiving when we were down there. So I couldn't really hide it, but I did not share numbers. And we still drop the zeros when we're talking about it, because it can be kind of mind-boggling, especially my parents never even had a mortgage on their house. So this is just something that's completely foreign and probably very scary for them to think about us doing.
Yeah, that's great. So speaking of your education, you mentioned you joined a local mentoring group. What other kind of education have you guys done, and what has that done to help you kind of get in the business and get the confidence, get going?
Well, when we had our first multifamily property under contract, 104 unit property in Irving, actually I say under contract, I was going through my CAM certification, Certified Apartment Manager designation through the National Apartment Association. It's locally run by the Apartment Association of Greater Dallas, at least the one I went to. We were negotiating that contract when I was doing what they call the CAM Blitz. It's a week-long course, and it's intense. So typically it's over a 6-month period, and you go once a month. This was all condensed in 1 week. And we actually got the property under contract in the middle of that course. So that was kind of fun to be able to go in and say, hey, yeah, we just got this property under contract. So, and the reason I took that course is because it's basically for managers, apartment managers. And going into this, I didn't really know that much about that side of things. So if I was going to be start the property management company and hire somebody that's going to be running this property, then I darn well better know what she's supposed to be doing on site. So that was really, really insightful, and I would do it again if I had to.
So starting out, you went out of the gate and you bought a 104-unit apartment complex and you decided to self-manage. Is that kind of what you just said?
Yeah, we pretty much jumped in head first, yeah.
Well, why is that? Why did you not hire a third-party management company? Why was that important to you to self-manage?
Well, we're talking about passive income and trying to retire Steve. Well, we get a percentage of, the management fee, and that would help boost our passive income. That was one reason. The second reason was that if I'm going to be answering to 13 other investors, because I'm the one that signed on the dotted line as the registered agent of the state, if I'm going to be having to answer to them, I want to know everything that's going on the property, and I want to be the one that decides how that ship is run.
Well, let's maybe talk a little bit more about Costa del Sol. Was the first property you guys bought in Irving, Texas. Maybe tell us a little bit about it and maybe some of the challenges and how did you guys put the deal together? How many investors? What kind of loan did you put on? Maybe just kind of give us a little brief overview.
I'll give an overview of the property itself. You can delve into the finances, Steve, if you want. So it was 104 units, all the same floor plan, all 1 bedrooms, 1 bath, 432 square feet. So we're talking tiny. A starter home or starter little apartment for, older people, not necessarily starter for them, but of a retirement place or young families. And one of the biggest challenges was limiting the number of people that could be in the apartment, because I think only 4 are allowed with the city of Irving with a 1 bedroom. Mm-hmm. And we constantly had to stay on top of that and walk the property unit by unit and just randomly check. And, you get to know. The manager knows who lives there, and they know when they've got 10 kids walking out of this apartment, something's not right.
Or 7 toothbrushes.
Yes, that too.
So that's some of the challenges there.
Yeah.
Just a little over occupancy.
And for the longest time, probably the first 2.5 years, we thought, okay, well, this is just a challenging property. The turnover's just going to be there. We're just going to have to anticipate that 15% turnover every month. And that totally was not the case. Once we brought in our rock team that we now have, boy, she took that property from 76% occupancy to 84% in a month. Next month was 93%, 98% the next month. And it stayed there. It was... Even
after pushing rents.
Yeah. And the rents are through the roof. We sold the property at $1.56 a square foot. Crazy. I mean, they're small units, but that's still really high.
Yeah.
So...
Well, that's great. So how did you put the deal together? So you went out and on your first deal, you ended up doing something unusual. You got a Fannie Mae loan on it, which is a little bit unusual. And normally when you start in the business, you start with like a community bank loan, sign recourse, and eventually graduate into a Fannie Mae loan. And you guys went right to Fannie Mae. So how was that done? How did you guys put that together?
Well, I'd say Paul was instrumental in helping out with the Fannie Mae side of things. Shari was the primary one putting together the investors. And I was still working corporate America then. So I was only involved from a distance, overseeing the numbers, the bookkeeping, during the loan application, doing a lot of the paperwork that I could in the evenings. And then once we had the property, dealing with the bookkeeping.
So I think how you guys had structured the deal, which was unusual, but it worked, is that we did, instead of 80% leverage or even 75 or even 70, we did 65% leverage. And that was acceptable to Fannie Mae because you had larger skin in the game, that they kind of broke through that wall to do 35% down, because you didn't have a problem with raising passive investors' money into the transaction. So you weren't so much challenged to have less money. You had more money, and you used that money so that you could have a Fannie Mae loan. So right out of the box at 65% leverage, we were able to get, I think, a 10-year term loan,
10-year note.
non-recourse, 30-year amortization. Now, here's the $64 question. Knowing what you know now versus what you knew then, and thinking that you wanted to be in that property for 12 years, would you have taken that same Fannie Mae loan looking back? I mean, and the reason why I asked that question is the yield maintenance penalty that you had to pay on the payoff, which was how much? $200,000?
It's just over $250,000.
$250,000. Now, that property had gone up in value tremendously, so that really wasn't an issue. But the seller didn't get the $200,000. The buyers didn't get the $200,000. The property didn't get the $200,000. Just the bondholders for Fannie Mae got the $200,000. Now, I thought things change in life, and I know that probably was the right decision at the time for you. But looking back, should we have done a different type of loan? Would we maybe have done a 5-year loan or a 7-year loan just to have a lower threshold of a prepayment penalty?
In hindsight, a 5-year loan may have been far more attractive.
Right.
But having said that, just want to say that we sold after 4 years on a 10-year note. We had one investor in particular holding out. He did not want to sell. He said, "No, I cannot get these returns anywhere else. I do not want to sell." And I said, "Shari, between us, if it were just us owning the property, no investors, I'd say we should hold it a little longer as well." I wasn't necessarily ready to sell, but the market was high. Some investors moved on, wanted to do other things. So the returns were good, the price was good, so we decided to sell.
Well, when we had our investor meeting to decide, are we going to sell, and we had to take a vote. Like we said, we had that one loan holdout, but it was the majority. So we raised the bar pretty high. We put it up to them. We said, we bought it for $2.75 million, and they said, "Would you sell it $4 million?"
We ran a variety of different scenarios.
Right.
$3.1 million, I think, was that our estimate?
That was a break even.
More or less a break even. We may lose 1% or something.
So they would get 100% of their funds back, but nothing over and above that.
After the prepayment penalty and the broker's fees, we basically wouldn't make anything. That was 3.1. At that point, there was only one investor wanted to sell. He said, "Yeah, I just need the money out." I think there were some personal bills he had to take care of with his kids. But we went to 3.2 million, different scenario, and we looked at what the returns would be. 3.3, still no one else interested in selling. 3.4, no one. At 3.5, that kind of tipped the balance. And most of the room said, "Okay, yes."
Yeah, we would consider it.
We need to consider it. They didn't say absolutely sell. They said, "We'll consider it." So we got an offer that was just over the 3.5 million. Took it to the members to vote, and it was unanimous then.
Good. Everybody left with a big smile on their face.
Yes, they did.
So looking back, is that you probably would have taken that loan because your intentions really were to hold that property for a while. So that would make sense. So you sold the property, but in the meantime, you had also bought another property too, Spanish Chase.
Right.
And tell us a little bit about that one. How many units?
77 units. It's also in Irving. It's less than 4 miles from Casa del Sol. Still South Irving. Constructed 1970-ish.
72, I think.
Yeah.
So was that similar to Casa del Sol? Was that like a value add, or was it a little bit more of like a stabilized type property?
It was marketed as stabilized, and by stabilized, I would say they had upgraded. I think there were 20-something units that had not been upgraded out of the 77, and it appeared, they put a lot of money into it, so it looked nice. We knew there were things that needed to be addressed, so I would call it more of a hybrid. And stabilized, yes, and the fact that it was cash flowing from day one, and that's what we look for. I don't ever want to lose money, so we always find something that is cash flowing from day one and still allows us room to go in there and make whatever improvements we need to just to get the property value up and to just make it a better place for people to live. But this one, it needed, I think, what did we put into that one? Capital improvements.
It was just over 200,000.
Yeah. It had some electrical wiring that hadn't been pigtailed properly or at all. Definitely some plumbing issues and roof, foundation. Oh, yeah. We had nearly $30,000 in foundation work that we had more than that. Yeah, it was 40,000.
And so walking into the deal, when you guys buy that, how long ago did you guys buy that property?
November 2012.
2012. So we're 3.5 years or so now into
Right.
it. Where was rental rates when you guys bought it, and kind of where have you taken it? I mean, approximately how much have you guys gone up? And do you think that's a function of what you guys have done in the market, or a combination of the two? Right. Yeah.
Both. The market's definitely demanding more rent, and the only reason we're not 100% occupied is because we are doing some capital improvements in terms of sewer line replacements. And so there are 3 units that we're going in now and upgrading. And once those are done, we'll be 100% occupied. But what that says is let's raise the rents again. But they're already far higher than they were when we bought them. I don't remember the exact rent numbers.
Well, another thing we did about February, March last year, we decided to implement RUBS. It had been, when we bought it, it had been run as...
so RUBS, a ratio utility billing system. So it has been run as all bills?
It
had been run as all bills. When we took it over, it was all bills paid. Then early last year, we decided to implement basically billing back the tenants for the utilities.
For all utilities or just water and sewer?
The water, sewer were the big expense that we need to control. So that was the initial one.
Trash,
pest control,
an
admin fee, and gas now. But not electricity.
So the property's still paying electric currently?
Yes,
Are you guys going to implement that at some point, or what's your strategy?
Yeah, we just didn't want to put it all on the tenants in one
time.
go. And we started off with the water because that was the biggest utility cost, the one that was most variable as well. Gas was surprisingly high for that property. And then the electricity, that was fairly stable month to month, so that wasn't so bad.
Got it. So you guys bought that property also with the Fannie Mae loan, 10-year fixed rate as well?
Correct. Same thing as we had before.
But 80% loan to value this time.
Yes.
80% loan to value. So you kind of came in at a lower leverage and were able to get normalized leveraged on your second transaction.
Right.
So what's kind of the strategy with that deal? Are you going to hold it? Are you looking to do maybe a supplemental loan and cash out, or what's the grand vision here?
We've had almost 12 months now, or just over 12 months of the RUBS income coming in, but it's still phasing in. It's a 12-month phase-in.
Sure.
So we want to let that season another 6 months or so, and then maybe later this year, third or fourth quarter, we're going to look at doing a refinance.
And do you think you'll be able to pull out all your initial investment and return to the investors?
It depends on the appraisal, but that's the plan, yes.
That's the plan. Yeah, that's a good plan. So,
and if it's not all of it, then it's going to be 90%.
That's great. That's great. Maybe we move on to one more property you guys did. You did a 91-unit property called Villas del Sol, also in Irving, and then you guys rebranded it. And so tell us a little bit about that deal.
Yeah, it's 91 units. It's a large property, though. The average square footage of the units is 1,082 square feet. So the largest unit is 1,470 square feet. So they're little houses, some of these. It's a really great unit mix. We got efficiencies, 1 bedroom, 1 bath, 2 bedroom, 1 bath, 2 bedroom, 2 bath, 3 bedroom, 1.5 bath, 3 bedroom, 2 bath. So really great unit mix. And the previous owner put a large sum of money, I can't remember how much, I think over $500,000 into the exterior alone. It's got a great courtyard with a gazebo and playground and a pool. So it's got some nice amenities for that area of town. And externally, it looks great. And they renovated, how many did we have left to do? I think they had renovated all of the interiors to just kind of a basic standard level.
They had, but with all the roof leaks, we'd got almost every unit needed touching, or every upstairs unit needed touching anyway, because of the water damage with the very wet springtime we had last year.
Yeah, we took over in late January last year, and that's when the monsoon and snow and ice hit the DFW area for months. And so we just had one roof leak after another. And we actually walked the property doing due diligence in the rain and didn't see a whole lot of problem. But wow, when you get that volume of water on a flat roof, it has nowhere to go but down.
Did you have an inspector walk that property with you?
Yes.
And did you find that very valuable? Were there things that he uncovered?
Definitely. Yeah. I would never purchase a property without a full due diligence inspection.
And then also, too, is that I think the greatest benefit of that property is really where the property is located at. It's on a busy street. How much of an impact do you think that busy street has for occupancy?
It's huge. We've got a street that goes right through the middle of the property. I was just talking about that the other day because we have so many cars that drive through there that I'm considering making those speed bumps a lot more severe. However, it's a good thing that there's a lot of traffic going through there because those are potential residents. And it is a city street. So unless we get the city to do it, that's not going to happen. So yeah, we have no problem with foot traffic by any means. It's right off of West Irving Boulevard. So.
Spanish Chase is the same way. That's on West Pioneer. That's a pretty busy
and
street
Beltline,
too.
yeah.
Yeah, and Beltline.
So you guys have benefit of having properties on fairly busy streets. So perhaps those people who come in looking for an apartment building that there may not be occupancy on this property may have to go take a look at your new property.
Mm-hmm.
So you can, that's one of the benefits of owning multiple properties in an area, that if one property is low, you can force people to go over, at least to take a look at the other opportunities that you have in your portfolio. And then you guys financed that property. Was that a bank loan or was it a Fannie Mae loan?
Fannie Mae.
And again, that was at 80% leverage on that one. And
correct.
You threw in some rehab dollars into that loan too. Was there enough coverage on that?
I can't remember how much it was in the loans, but 165, I think, in the loan.
Yes,
but
165 in the loan.
The total rehab of 325,000.
So on that one, the debt coverage was only enough to throw in $130,000 into the deal, but you needed another $150 or maybe $200,000. So you had to take money out of your equity raise to put that into the deal. We weren't able to put all the money under the loan into the transaction. So but that was an 80% loan.
Correct.
On that one. So you did a non-recourse, another Fannie Mae loan. So the one that I really want to talk about is one that you just closed last week or 2 weeks ago, and that's 184 doors.
Correct.
Same general area. How far from your properties is only, about a mile or 2 or 3? Not very far?
It's a half a mile, or not even, like a quarter of a mile from our first property that we sold, Casa del Sol, so up the street.
So you knew the general
Yep.
area and the demographic that went through it. So how did you guys find it? How was that opportunity brought to you?
We actually looked at that property and put an offer in on it 2 years ago, and it was a bidding war. I think they had at least six letters of intent that they were considering. We came in second. We were comparable in terms of the offer price, but the ones that ended up getting the deal back then put $600,000 cash that went hard 10 days into the inspection period. We weren't going to gamble with our investors' money like that, so we're like, okay, take it. And so then when it circled back around, we got a phone call from our multifamily broker who said, hey, Silverado's back on the market. And just so happens that the seller's broker is the same guy that sold our Casa del Sol, the first property, last summer. So we knew how he worked and he knew how we worked. And so I think he was probably also instrumental, along with Paul, in kind of helping us sign on the dotted line, so to speak, for the contract for that. So it was an interesting transaction.
How was I even part of that equation?
Well, I think you were at some meeting down in Florida where I think the seller was, and you just kind of sit down and had a little chat with him and said, yeah, Goulds are good people. They can close the deal. They've got the funds. They've got it all raised already. And it took a little convincing, I think.
Good old Paul patting himself on the back. That's great. So tell us a little about that deal. We haven't really talked much about the investors. How many investors do you guys have in this deal, and how does that compare to some of the other ones that you've done?
On Silverado, we had about 28 investors.
Oh, wow.
Now, I hesitate on that because there's one gentleman invested both personally and then through two companies he owns. So is that one investor or three? But
yeah, sure.
It's around 28, 30 investors. We raised just over $3 million.
And how does that compare to, say, not Villas of Solomon, but Village on West Creek deal that you guys, the last deal you did before that, as far as number of people?
We had 23 on that one.
Okay.
Yeah, but only 12 on Spanish Chase. That was so much smaller.
Sure.
Yeah.
Sure. And so how has it kind of changed for you guys? I mean, you've been in business now doing apartments for about 4 years or so. And so how's life different today versus when you guys did Casa del Sol, back in 2012?
Well, Steve's retired.
Yeah.
So we work together now.
Yeah, it was quality of life more than anything. I don't have to show up for work at 8:30 in the morning, stay till 5:30 at night, and if I want to leave early, well, I'm not even at work, but I can take off whatever time I need to go attend events with the kids at school without having to ask anyone's permission except for Shari. She's my boss now.
So how do you find now that you've done 4 or 5 deals now? How was a capital raise on Silverado relative to how easy was it to raise money on Casa del Sol? Is it easier, harder?
Oh, you have no idea how much easier it was.
And
that was very, very stressful.
So
with
why is
Casa.
that? You think that's a function of the market, or your track record, or both, or what?
It was. We didn't really have much of a track record back then, and the only thing we had was people's confidence in us, and that to me is a huge part of who you bring in the deal. Even though we had nearly 30 investors in this one, I know all of them, and I know who they are. They know me, and we have had lunch, and I know them personally, and they know us personally. It's a business deal that you're in with these folks for a good 4 to however long, years. And they have to have confidence in what we're doing, because we can't have people coming up to us every other day saying, hey, why didn't you do this? Why didn't you do that? They trust us, and we take it very, very seriously, the funds that they've entrusted with us to make them money. That's what it's for.
So in Silverado, were you in a position where you guys were oversubscribed and having to turn away potential investors?
Oh, yeah. Yeah.
A month before closing, we weren't turning away people so much as we just weren't accepting anyone else. And we actually had a waiting list. So right at the end, we had one investor that needed to drop out, and we were able to replace him. We actually pulled in 2 other people very quickly, but we knew one of them had previously invested with us. The other we knew had a high net worth and was ready to go, eager, chomping at the bit. So we pulled in those 2 at very short notice.
And we do still have a lengthy list of people that did not get in this deal that we'll be reaching out to that have expressed an interest in our next deal. So
It's a very competitive market right now, and Shari was correct. I talked a little bit to the sellers and got their confidence level up that the Goulds were the right people to buy the property. But you still, that's one thing to say that, but the other thing is that you also had to go hard with earnest money fairly quickly. And how much was that? And what was your time frame in that?
We started off by putting down $250,000 earnest money, but not all of that went hard day one. Day one, only $15,000 went hard.
right.
But we had to put $250,000 up front as earnest money.
And that went hard after financing contingency ended, which is when we know we've got the appraisal that came in where we wanted it to. We've got the loan terms that we want. Fannie Mae's happy with the deal, and we're going to close.
So you started off when we apped the transaction that we actually pushed out an application to you guys, it was for X amount. And then by the time you closed, it was for X plus amount. So what was good about that is the seller didn't take their foot off the gas and have operations fall back or fall down or go sideways. The value of the property actually probably went up because the NOI went up, the rents went up, the expenses stayed in line. So we actually were able to give you a higher loan amount than what we had done when we put the application together, maybe 30 or 45 days prior to that. So that had got to feel better that you were able to get more loan dollars at almost at 80% leverage plus $500,000 worth of CapEx rehab into
Just
the loan
under.
too.
That's what we have financed, but we're putting more than that into it.
Yeah, that's still amazing that the loan amount went up during the transaction itself. Now, you guys have talked about that you're self-managing your assets. How do you feel the economy is doing these days? I mean, are you guys giving concessions to get these tenants in the property? I see your head shaking no.
No, we've scaled back on those.
We don't need to.
In fact, our manager at one of the properties until a few months back was giving concessions. Multiple different move-ins, but up to about $1,000 a month. Why are we doing this? No one else in the market is doing concessions right now. So let's scale back. And I just looked at April's numbers. She scaled that right back to $100 in concessions from $1,000.
Wow.
So, it's not really necessary now.
That's amazing. Now, who do you guys use for your software provider for the
Property management.
property management of the property?
It's ResMan.
And why do you like those guys?
It's a very powerful software solution. It's all hosted online, so we don't have to install anything on site. As long as there's a browser on site, they can get to ResMan. So, and having worked in corporate IT, I know if you have a server inside a store, it can walk, it can get flooded. the cleaning lady can knock a bucket of water over and it's destroyed. You don't want your critical data there. You want your critical data elsewhere. So a hosted solution is much better for that. ResMan provides that. They're constantly updating the software. They get an update every month or so. Always listen to the user feedback and adding new features. So it's a good solution.
And it's a local company, so they're easily accessible, and they listen to us as to what other kind of reports or other functionality that need to be integrated.
So you guys have kind of put together a team. I mean, you have Old Capital as part of your team. You have other groups a part of your team. Tell me about your attorney. You know, you guys have a good relationship with your attorney. How critical is having a good attorney on your team?
I can't tell you how critical it is. I mean, during our phase into, I guess, my freelance writing, I was also working on my master's in criminal justice. And I had never had any idea when we got into the multifamily side of things how critical it is to be able to understand and read legal documents and interpret what they're saying and read it to the level of detail in the contracts, the contract negotiation portion of it. That's huge. Our attorneys are absolutely amazing. I would not want to be on the receiving end of any of them. They are the best at what they do. It's Heiger Allen Lawton, and Jean Kim is our primary point of contact when we need anything because she points us to the right person within their organization. If we need a litigator to go stand in court with us because we're evicting someone for something other than non-payment of rent, that's something I didn't know until a week ago, by the way. Then she points us to the right person. And our contract attorney, Tracy McGoy, she's so thorough with every contract. And do we want to assume this one? This one says this and it shouldn't. And just working back and forth with the seller's attorney in terms of the contract that we sign with them for the sales contract. The level of detail that you have to get to in that part of the negotiating, if you don't have someone that stands behind you and everything that you want and looks out for you, then you could run into some serious problems later down the road or even right then. So, yeah, I can't stress enough how important it is to have an attorney.
Well, kind of
good one.
Yeah. So kind of wrapping up here, maybe you guys can share with the group a funny story or maybe some challenge that you guys overcome or both along the way in your last 4 years of being in multifamily. Maybe a funny story of managing hundreds of units. I'm sure you run across all sorts of strange things, day to day in the activities.
I got one. April 1st, last year, April 1st, right? April Fool's Day. Well, I didn't think about that. I just don't play tricks on people like my husband does. Anyway, the day before, we still owned Casa del Sol back then. And the day before that, there had been a home invasion at our property, and our resident shot the intruder. Makes sense. I wasn't too bothered by it. Anyway.
Only in Texas.
Sorry about that.
Exactly.
So that kind of stressed me out anyway, just having happened there. And so the next day I was driving down to Casa just to kind of assess the situation, see where we stand. On the way there, I get a call from my darling husband here who says...
I thought it was a text. I just dropped the kids off at school and heard on the radio, just the news radio, that there had been a man passed away in an Irving hospital overnight as a result of an apartment shooting. Now, I knew it. I can't remember what the apartment was, but they mentioned it, and I knew it wasn't Casa del Sol. But I thought, if Shari hears just half of that or sees some of that, that'll be enough to set her off. So I just texted her, hey, I just heard on the radio a man died overnight in Irving Hospital as a result of the apartment shooting.
So I was having heart palpitations at that point. I got to Casa and sat down and said, we've got to start looking this up online. We've got to find some more information about this. Who is this man? Let's make sure it wasn't our guy. And so I had Aurora over at the Village on West Irving and everybody at Spanish Chase and our girl at Casa online looking up anything they could find out about it. In the meantime, I get a phone call from Aurora over at the Village on West Irving who called our manager at Casa that I was sitting right there in front of. And she passed, well, actually, that's not all of it. My darling husband also Aurora texted me and told me that the roof over at the Village had caught on fire because of the oil that they were using to
resurfaced
the flat roofs. So she couldn't take it. She couldn't lie to me. So she called over and said, I couldn't do it. I can't do it. Steve made me do it. It didn't really happen. So this was my April Fool's. And the worst part of it is I got all the way home and told Steve, look, I can't find anything about this person that died in Irving and in the apartment. And he just had that Cheshire cat grin on his face and said, that wasn't our apartment, was it?
I could believe
I fell for it the whole day. I trusted my husband.
And so you should.
Yeah, so it was kind of a long story, but that was my April Fool's joke.
That was a funny story. I like that one.
I told him I'm not coming out of my bedroom April Fool's this year.
Yeah, almost making the blood come out of your ears of stress and that type of stuff. But you like being in the apartment business?
Yeah, absolutely I do. We have a really great team of people, and it just doubled because we just doubled in size and the number of units we own. But that's the fun part for me, is to be able to provide a nice living for them. And it's so nice to be able to give them raises and how happy it makes them, and bonuses for doing a good job and improving the properties and just helping other people have a better quality of life as well.
Yeah.
So it's very satisfying.
The Silverado property was a very stabilized asset, and you guys are going to do some upgrades to the property, but it doesn't really need too terribly much. I mean, it just takes a good manager on site, good management company as an asset manager like what you are in and around the property that can kind of oversee the asset itself and be responsible back to the passive investors about how things are going. So I think that you guys have a good track record, and hopefully this one will be another success story that we can talk about, 2 or 3 years from now, that you guys started off on the right path and everything is working out well and continues to do well. So anything more to add, Mike? I don't think so. Anything more do you guys want to add?
I appreciate you having us here.
No, thanks for coming in. We appreciate you telling your story and telling us a little bit more about your success. Hopefully you'll be doing another transaction by the end of the year or the first part of next year.
That's the goal.
I know that's the goal. So we appreciate it. Thanks for coming in. Thanks for listening to the Old Capital Real Estate Investing Podcast. Thank you.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.